There is a company trading hands right now for $150 million. It started with a used snack machine in a break room in a city you have never heard of. The person who bought that machine did not have a vision board. They had a van, a cooler, and a spreadsheet they built themselves at 11 at night. Between the machine and the HoldCo there are 5 distinct levels, and at each one, most people quit. Not because the business failed, because the business was boring, and boring is harder to stay inside than people expect. This is what each level actually looks like, what it costs, what breaks, and what small edges end up mattering far more than they should. Level 1. One machine. You are not starting a vending empire. You are buying an education with a physical object attached to it. Here is how it starts. You find a used machine on a resale marketplace. A crane or an AMS or a USI, something with a working bill validator and a coin mech that does not jam every third transaction. You pay between $800 and $2,200 depending on condition and whether the seller knows what they have. The machine weighs somewhere around 600 pounds and requires 2 people and a hand truck rated for that load. You do not know this until you need to know it. You place the machine. Office buildings, small manufacturing floors, auto repair waiting rooms, apartment complex laundry areas. The goal is not a high-traffic landmark. The goal is a location that will let you learn without punishing every mistake at scale. You pitch the location manager directly. You offer a commission, typically 8 to 12% of gross sales, and you do not make the mistake of offering more than you can model. You write a simple one-page agreement that specifies the commission rate, the exclusivity of that product category, who is responsible for power, and the termination window on both sides. You carry general liability insurance because the location will ask and because it costs less than $150 a month for a sole proprietor policy at this scale. Getting the spot feels like the hard part. Keeping it is harder. The location manager who liked you leaves 6 months later. Her replacement has a brother-in-law with a root. Product mix is where most first machines go wrong. You fill it with what you would want to eat. Then you learn that what the population in that specific break room wants to eat is different, and the only way to know is to watch what sells and what expires. Chips at $1.25, candy bars at $1.50. A few healthier options for the optics, and because one person in every office will email a complaint if they are not there. Drinks are better margins if you have a separate glass front cooler, but you do not have that yet. Gross margin on chips and candy runs 25 to 35% after product cost. Protein bars and healthier items run lower, sometimes under 20%, and they spoil. Stale inventory is a loss that does not announce itself. You pull a bag of pretzels 3 weeks past code because you did not notice, and you just absorb the cost of the slot, the product, and the restocking trip. The telemetry question matters more than it sounds. A machine with DEX-port compatibility and a card reader that reports sales data in real time costs more, but it tells you exactly which column is moving and which one is not. A cash-only machine tells you the cash in the box minus what you put in equals what's sold, and that accounting breaks the moment someone counts wrong, which happens. Card fees run around 8 to 12 cents per transaction plus 1.5 to 2.5%. On a $1.50 sale, that is meaningful, but cash machines create their own friction. You are counting bills on your kitchen table. You are making deposits. You are reconciling against a handwritten log because the alternative is not knowing if the machine is underperforming or if something is walking out the door. Shrinkage is real. Theft by the person servicing the machine is the most common form and the hardest to detect. You are the person servicing the machine. That means you are building systems to keep yourself honest, which sounds strange until you realize the systems are for when you hire someone else. Collections cadence. You visit once a week at this scale, maybe every 10 days. You bring product in a soft cooler, you pull stales, you count cash, you restock, you photograph the machine. The visit takes 45 minutes including drive time. On a machine doing $200 a week in gross, your margin after product, commission, and the card reader fee is somewhere between $50 and $70. Not a salary, a tuition payment. Sales tax on vending varies by state and by product category. In some states, food sold through a machine is taxed differently than the same food sold over a counter. You find this out from a CPA or you find it out from a notice. The CPA is cheaper. The failure modes at level 1 are specific and common. Vandalism, not frequent, but when it happens the repair cost can exceed a month of profit. Power outages that trigger customer refund requests you cannot verify. Locations with worse foot traffic than you were told, where the machine does $200 in month 1 and $80 in month 4 because the initial novelty wore off and the real usage pattern revealed itself. Poor planogram, which means putting the wrong product in the wrong slot and watching the best sellers sell out by Tuesday while the bottom row sits untouched until your Friday visit. And the anchor location loss, which is when your best machine gets displaced because the building signed with a national operator who offered the property manager a flat monthly fee plus a revenue share plus a brand. You cannot compete with that. You file it and adjust. What the boring and mispriced edge looks like at this level is unglamorous and specific. You visit at the time the machine is most likely to need restocking before the week's heaviest traffic. You keep the machine clean because the location manager notices, and the alternative is a conversation you do not want. You answer the phone when the location calls. You fix problems the same day. You are not building income yet. You are building a reputation inside a 2-mile radius that will matter at level 2 in ways you cannot fully price right now. By month 8 or 9, the single machine is profitable enough that you understand the model. Not well enough to scale it, well enough to know it is real. That distinction matters. A lot of people mistake early confirmation for permission to move fast. The ones who build something durable move to the second machine the way they move to the first one. Carefully, with a specific location already identified and a reason beyond wanting more. Level 2. A small route. 5 to 20 machines in a defined geography. The geography is the thing most people get wrong. You want density, not coverage. 5 machines in a 3-mile radius are worth more operationally than 10 machines spread across 20 miles. The fuel math is obvious once you run it. 45 minutes of drive time per stop on a dispersed route becomes 12 minutes per stop on a dense one. Time is inventory. Time spent driving is time not spent on the machine, not spent finding the next location, not spent on anything that compounds. Route density is not a convenience preference. It is a unit economics decision. Choosing the next 5 to 20 placements means saying no to locations that are geographically inconvenient, even if the foot traffic sounds appealing. A factory doing $280 a week that sits 17 miles outside your core cluster will cost you more in time and fuel than the incremental margin justifies once you model it honestly. You model it honestly. Revenue per stop, product cost, commission rate, drive time at your actual hourly cost, card reader fees, and estimated service frequency. If the number does not clear a threshold you set in advance, you pass. The threshold is not negotiable in the moment because in the moment every location sounds better than it is. Commission structures change as you grow. A single machine operator offering 10% of gross is a small vendor in a location manager's mind. A route operator servicing 8 locations who has a track record and references and answers the phone on Saturday is something different. Some locations, especially corporate campuses and healthcare facilities, expect 15 to 20% plus a guaranteed minimum. Those locations have leverage. They know their traffic. You know your margin. The negotiation is honest when both sides understand what the machine will actually do in that specific environment. A location that demands 20% commission on a machine that will gross $160 a week is not a location. It is a cost center with a machine in it. The per-stop economics at route scale, gross revenue minus product cost, minus commission, minus prorated card fees, minus shrink allowance, minus allocated drive time and fuel. At a healthy stop, you clear $40 to $80 per week. Across 15 stops, that is $600 to $1,200 per week in cash flow before any financing costs. Not a salary yet at the low end. A business at the high end if the route is dense and the machines are performing. Inventory management is where routes go quiet before they die. You establish par levels. Each machine has a specific quantity of each product it should hold at restocking, based on actual sales velocity, not what you think should sell. You build a simple order sheet. What sold since the last visit? What is approaching code? What needs replenishment? You carry a physical count log in a 3-ring binder or a spreadsheet synced to your phone. Every visit is timestamped. Cash collected is recorded against expected sales from the DEX data or card reader report. If the number does not reconcile within a small tolerance, you know before you leave the parking lot. Shrink control at this scale is not a sophisticated system. It is a consistent habit applied the same way every time. The bookkeeping gets its own rhythm, a separate bank account for the route by this point, not optional. Cash deposits logged by location and date, expenses categorized weekly, not monthly. A simple KPI sheet, sales per machine per week, spoilage rate as a percentage of product cost, machine downtime in hours per month, commission as a percentage of gross by location. You look at this sheet once a week. It is 1 page. The machines that are dragging the average tell you something. Sometimes it is the product mix. Sometimes it is the location. Sometimes a machine that was profitable in year 1 has been slowly declining because the business next door moved and you missed it. Financing the next machines. The cash flow from a dense route of 10 to 15 stops, if you have not pulled it all out, accumulates. You reinvest it. Used machines on resale routes come up regularly because operators retire or give up at exactly this tier. A seller note on a used route is common. The retiring operator carries 10 to 30% of the purchase price at a negotiated rate because it closes the deal and they trust the asset more than they trust finding another buyer. Equipment loans through small business lenders exist for machines. The rates are not favorable. But when a good location becomes available and you need a new machine in 30 days or you lose the spot, debt becomes tempting in a specific and understandable way. You take the loan knowing the machine needs to clear its payment by month 3 or the math does not work. You build that into the model before you sign. Level 3. Micromarkets and a part-time helper. A micromarket is an open format setup. A small refrigerated case, a snack rack, a self-checkout kiosk. No machine front. The location stocks it like a small honor system store, and customers scan and pay at the kiosk. Revenue per location can run 2 to 4 times a comparable vending machine in the same space. The per unit economics look better immediately, and that is the moment you should be most careful. Shrink in a micro-market is structurally different. A vending machine dispenses one item per transaction. A micro-market trusts the customer to scan everything they take. Some customers do not scan everything they take. Shrink rates of 8 to 15% are not unusual in poorly managed micro-markets. The kiosk needs consistent connectivity for card processing. A card reader that goes offline in a vending machine creates friction. A kiosk that goes offline in a micro-market shuts down the entire location's ability to transact. Your phone receives the alert. You drive there. It is 40 minutes away because this one was outside the density rule you set, and you bent it for a high-traffic corporate campus that was too appealing to pass. The part-time helper changes everything quietly. You hire someone, a neighbor, a referral, someone who needs 15 hours a week. You show them the route. You trust them with a van key and a cash bag and a restock list. The first time they do the route without you, you are aware of every hour they are out. Not because you distrust them, because the cash is not yours in a limited sense anymore. It passes through other hands. The systems you built to keep yourself honest now need to keep someone else honest, and that is a different problem. You build verification into the process, not accusation. The cash log is signed at each stop. The DEX data is pulled remotely. The photograph of the machine at service is time-stamped and stored. You review these things, not every day, but consistently enough that everyone knows you review them. Moving from operator to scheduler is not a promotion. It is a shift in what you are responsible for. You are no longer the person who knows exactly what happened at every stop. You are the person who designed the system that is supposed to tell you what happened. The gap between those two things is where theft lives, where stale inventory accumulates, and where a high-commission location you should have exited 6 months ago continues to drain the route because the person servicing it does not have the authority to recommend dropping it, and you are not visiting often enough to see it yourself. The failure modes at this tier are quieter than at level 1. They accumulate before they announce themselves. Overexpansion into locations outside the density zone strains the helper's schedule and your oversight simultaneously. One machine with a card reader that drops offline every 3 days costs you the location if you do not fix it in the window the property manager is still patient. An employee who takes small amounts consistently over 4 months is harder to detect than a single large theft and damages something harder to repair than the cash loss. And the location that made sense at 8% commission now wants 18 because a national operator called last week. You either reprice the economics or you negotiate or you exit. Exiting is not failure. Exiting a bad location to protect the route's average is the decision that keeps the route healthy. The boring edge at this level is still the same edge. You are present in a business that most people abandon when it requires this much administration for this little glamour. The machines do not care. They run or they do not. The cash accumulates or it does not. The route is either dense enough and managed tightly enough to compound, or it is a collection of individual problems wearing the same name. That distinction is entirely within your control, which is both the point and the ongoing difficulty. Level 4. Buying routes instead of building them. At some point the math changes. Adding one machine at a time to a dense route is disciplined and correct and slow. A competitor 3 counties over has 42 machines, a warehouse, a part-time driver, and an owner who has been doing this for 19 years and is 63 and tired. That route took him 2 decades to build. It could be yours in 90 days. That is the thesis, and the thesis is correct often enough to be dangerous. Buying routes instead of adding machines can compress years of organic growth into a single transaction. It can also compress years of financial stability into a single catastrophic overpayment. Both outcomes come from the same impulse. The business looked good on the surface, and the buyer wanted it to be true. Valuing a route acquisition requires 2 numbers in tension with each other. The per-machine heuristic, somewhere between $1,000 and $3,000 per machine depending on age, brand, and payment capability, gives you a floor and a ceiling before you open the books. The EBITDA multiple is where the real conversation happens. Small vending routes trade at 2 to 3.5 times, trailing 12-month EBITDA, sometimes lower when the seller is motivated, sometimes higher when a buyer has not done this before. You use both methods. When they diverge significantly, you ask why. The answer is usually one of three things. The locations are better than the machine suggests, or worse, or the books are not clean enough to trust either number. Location quality is not visible in the financials. A route with 12 machines inside contracts with anchor accounts, a regional hospital system, a school district, a manufacturing plant with 400 employees on rotating shifts is a different asset than 12 machines in 12 different small offices where the contact listed is the office manager who left 8 months ago and nobody updated the file. You visit the locations before you close, not a sample. All of them. You look at the foot traffic. You look at the condition of the surrounding space. You find out whether anyone at that location knows the seller personally, because if the relationship lives in one person and that person is leaving with the check, the account can leave with them. Earnouts and seller financing are not optional at this level. They are how you protect yourself from what the seller knows and has not said. A seller who carries 15 to 20% of the purchase price on a note payable over 2 years has a financial reason to tell you the truth about the difficult locations. An earnout tied to revenue retention at the anchor accounts for the first 12 months means the seller has a reason to introduce you, to make the calls, to smooth the transition. These structures slow down closings. Sellers who are genuinely confident in their accounts accept them. The ones who push back hard on earnouts are telling you something. SBA 7A financing is the primary instrument for route acquisitions at this scale. The program allows up to $5 million with 10-year terms on goodwill-heavy acquisitions and down payments as low as 10%. The rate is tied to prime plus a spread, variable unless you negotiate fixed, and in a higher rate environment that spread matters. What the brochure does not emphasize, you are signing a personal guarantee. Your name, your assets, not the LLC's yours. The bank will also impose debt service coverage ratio covenants, typically 1.25 times, meaning for every dollar of debt service, the business must generate $1.25 in cash flow. When an anchor account goes dark in month 7 because the manufacturing plant downsized, the DSCR covenant can breach before you have time to replace the revenue. The bank does not call this a surprise, they call it a default. The conversation that follows is not the one you planned. Integration is where acquisitions die quietly. You inherit pricing that does not match yours, planograms built around the previous owner-supplier relationships, machines with payment systems that require a different backend than the one your existing route runs. Standardization is not optional, but it has to be sequenced. You cannot reprice 50 machines and switch suppliers and upgrade card readers simultaneously while maintaining service levels at locations that have never missed a restocking visit. You prioritize payment tech first because it affects revenue visibility and card acceptance. Supplier consolidation second because it affects margin. Pricing and planograms third, incrementally, location by location, with eyes on what happens to sales velocity after each change. The people problem arrives before the integration problem. The acquired route has a driver who has been doing this since before you owned your first machine. He knows every location manager by first name. He knows which machine in the hospital annex runs cold and needs the thermostat adjusted quarterly. He is either your most valuable asset in the transition or the person who leaves in month 2 and takes institutional knowledge the books never captured. You pay attention to this before you close. What does he make? What does he want? Is there a path where staying makes sense for him? If there is not, you build the knowledge transfer into the transition timeline before the deal signs, not after. Bonus structures at this layer have to be tied to outcomes that matter. Uptime percentage per machine, revenue per stop per week, shrink rate as a percentage of product cost. Not hours logged, not miles driven. A driver who hits every stop on schedule but leaves machines half stock and does not report a broken bill validator is not performing. The metrics tell you before the location manager calls to complain. Entity separation is not paperwork, it is architecture. The equipment sits in one LLC. The operating company sits in another. The operating company leases the equipment from the equipment entity at a rate that is documented, arm's length, and consistent. Cash flows upstream through management fees or distributions, not through informal transfers between accounts that will confuse an accountant and alarm a lender. Insurance at this scale includes general liability, product liability, commercial auto for the route vehicles, and a crime policy that covers employee theft. The crime policy is the one most operators skip because it feels pessimistic. It is not pessimistic. It is accurate about what happens when cash moves through multiple hands across 50 locations every week. The failure modes at this level announce themselves through the P&L before they announce themselves through anything else. An anchor account that represented 22% of acquired revenue and exits because the new contract did not transfer cleanly takes the deal thesis with it. A culture clash between your systems-oriented approach and the informal relationships the previous owner maintained across locations erodes goodwill faster than any financial model captures. Route overlap that looked like operational efficiency on the map turns out to add 40 minutes to the driver's day because the sequence does not work the way the spreadsheet assumed it would. And the books you bought, the trailing 12 months the seller presented, had a quarter of non-recurring revenue baked into the baseline that the seller did not volunteer and you did not catch because you were moving fast and the deal felt right. Rolling up operators into a regional platform works. It works the same way everything at this level works. Slowly, carefully, with more due diligence than feels necessary and more patience during integration than feels productive. The boring edge does not change just because the transaction size did. It compounds or it does not. The discipline that got you here is the same discipline that keeps you here, applied now to a larger and more complicated version of the same machine. At some point, the vending platform stops being a vending company. The infrastructure you built to run 50 machines, the warehouse, the route software, the maintenance technician who can rebuild a compressor without calling a manufacturer, the back office function that handles payroll and vendor invoices and quarterly tax deposits, that infrastructure has a fixed cost that does not scale linearly with the number of machines it supports. You have built overhead that is hungry. The question becomes what else it can feed. This is where adjacent boring businesses enter: ATMs, laundromats, car washes, amusement and arcade routes. Each one is a cash flow asset with a physical footprint, a maintenance requirement, a location relationship, and an operator market full of tired owners who built something real and want to exit cleanly. The adjacency is not about diversification for its own sake. It is about operations. Your route driver already passes the laundromat. Your maintenance tech already understands electromechanical equipment. Your back office already processes cash reconciliation across 50 locations. Adding verticals into that existing infrastructure is not the same as starting over. It is closer to adding lanes to a road that already exists. The operating group model formalizes what the platform already does. Shared HR, shared accounting, shared procurement, shared maintenance, shared route logistics. Where synergies are real and where they are fantasy requires honesty. Procurement savings on cleaning supplies across a laundromat portfolio are real, assuming one regional manager can effectively oversee vending, car wash, and ATM operations simultaneously without breaking something is fantasy until proven otherwise. You test it before you staff to it. Asset ownership changes the valuation conversation entirely. A laundromat inside a leased strip mall space is an operating business. A laundromat where you also own the real estate underneath it is a different instrument. The business generates cash flow, the real estate appreciates, can be refinanced, and secures debt at rates the operating business alone cannot access. When you buy property under stabilized cash flow locations, you change the risk profile and the exit multiple in ways that show up clearly when a buyer eventually prices the portfolio. The HoldCo architecture at this level is not optional and not cosmetic. Separate operating companies per vertical, a separate equipment and leasing entity that owns the machines and leases them to each OpCo at documented, arm's-length rates. A separate real estate entity that holds the property and charges market rent to the businesses occupying it. Clean cash flow waterfalls that move money upstream through management fees and distributions, not through transfers between accounts that blur liability walls and make a lender nervous. The structure protects each vertical from the others. A laundromat with a liability event does not touch the vending OpCo's balance sheet. That wall has to be real, maintained, and documented every year, not just built once at formation and forgotten. Reaching $150 million in enterprise value is not a dramatic event. It is the result of acquiring stabilized cash flow assets at reasonable multiples, refinancing them as they season and prove their numbers, using debt that the business can actually service under a stress scenario, and growing slowly enough that integration does not collapse under its own weight. The capital stack at this level includes senior bank debt, SBA facilities on individual acquisitions, seller notes that keep sellers financially aligned through transition, and equity you have compounded from the first machine forward. Disciplined leverage means the portfolio generates enough cash to service debt, fund maintenance, fund growth, and still produce a distribution. Over-leverage means a bad quarter in one vertical threatens the entire structure. The boring empire does not fall to a competitor. It falls to its own debt service in a slow month. Late-stage failure modes are quieter than early ones and harder to reverse. Integration debt accumulates across acquisitions until no single general manager fully understands any vertical well enough to catch what is slipping. Key person risk at the GM level is real and underestimated. One departure can reveal that institutional knowledge was never transferred, never documented, never systematized. Compliance and tax mistakes in cash-heavy operations attract attention that reorganization cannot easily undo. And deteriorating service quality, machines that are not restocked, laundromats that are not cleaned, car washes with broken bays that stay broken for 6 weeks, kills locations quietly, one relationship at a time, long before the revenue line shows the damage. None of this is theoretical. Every failure mode described here has ended a real operator's real portfolio. The boring edge is real and the boring risk is equally real. They are the same business. Here's the only takeaway that matters if you are at the beginning. Buy or place one machine. Track 3 numbers: revenue per week, cost of goods as a percentage of revenue, and uptime percentage. Run those numbers for 90 days. Understand what one location actually does before you imagine what 50 would do. The empire described in this video did not start at $150 million. It started with a number in a spreadsheet that was small enough to be embarrassing and honest enough to be real. Everything here is educational. None of it is financial or legal advice. Every situation is different. Every market is different. Every operator is different, and what worked in one context will not automatically transfer to another. Consult qualified professionals before making any financial or business decision. If this breakdown was useful, subscribe. There are more tier-by-tier walkthroughs on the way. The next one starts where this one did: small, specific, and slightly uncomfortable. That is the only place worth starting.